Değerli misafirlerimiz, devam ediyoruz programımıza. Programımızın yeni konusu para politikası, finansal istikrar ve yenilikçilik isimli konferans olacak. Şimdi oturum moderatörümüz Merkez Bankası Başkan Yardımcısı Profesör Doktor Sayın Turalay Kençi ve konuşmacılarımız BIS Para ve Ekonomi Departmanı Başkanı Claudio Borio, Sırbistan Merkez Bankası Eski Başkan Yardımcısı ve Avrupa İmar ve Kalkınma Bankası Baş Bölgesel Ekonomisti Bohan Markovic, Macaristan Merkez Bankası Para Politikası Kurulu üyesi Gyula Preşenger'ı sahneye davet ediyorum.
Okay. Well, thank you. Good morning. Welcome to the session on monetary policy, financial stability and innovation. To describe the role of these key words in policy making, I'm going to borrow Donald Rumsfeld's this famous description. So we have known knowns, we have known unknowns, and we have unknown unknowns. So let me try to put my perspective on that and tell you which is which. Starting with innovation, well, on the surface, innovation looks like a known. But what the global financial crisis taught us that in practice, innovation can be an unknown. And then now turning to financial stability, it is kind of known unknown that we don't know much about financial stability. Finally, monetary policy. Well, there is no standard monetary policy. As my governor explained excellently, there are two monetary policy. One is the conventional monetary policy, and the other one is the unconventional monetary policy. So I'm going to describe conventional monetary policy, a known, whereas the unconventional monetary policy is our unknowns. So this is quite complicated. So therefore, I'm going to refer to our three excellent panelists to shed some light on these three and highly talked topics in the policy-making world. We are going to start with our first panelist, Claudio Borio. I don't need to describe Claudio much. All I like to tell you that he has distinguished writings on monetary policy and financial stability. As a result of that, he has recently appointed as the head of monetary and economic department at the BIS. He's kind of chief economist at the BIS. He has been the writer of the main economic reports that the BIS publishes. So, Claudio, floor is yours.
Well, thank you very much to Rely, and thanks in general to the organizers for having invited me here. It's really a privilege to be with you today. Now, the title of the session is Monetary Policy, Financial Stability and Innovation. What I would like to do, though, is to broaden the focus a bit away from innovation per se, and try to look a bit more closely at what is common across the episodes of a serious financial crisis. And in that context, I will argue that financial innovation, if you like, is more a symptom rather than a deep cause. And I will illustrate this with a couple of themes that we have developed in the latest BIS annual report that came out in late June, but which are also a bit of a kind of leitmotif in the BIS research over the years. And those couple of themes are what I would call the financial cycle and the debt trap. And in the process, what I will do is to explore the relationship to the trend declining real interest rates that the governor alluded to before, and also to this idea of secular stagnation, the risk of a period of slow growth for the world economy going forward, a very prolonged period of slow growth. There are basically three takeaways from my presentation. The first is that it is not possible to fully understand the challenges that the global economy is facing without appealing to the notion of the financial cycle, because an outsized financial cycle was at the very root of the great financial crisis that started in 2007 and 2008, and whose aftershocks are still with us. And the great financial crisis, together with the policy response to it, are still shaping the course that the world economy is taking. The second takeaway is that coming to grips with the financial cycle calls for more symmetric policies, by which I mean monetary, fiscal, and prudential policies, across the boom and bust phases of these cycles. And I think we've made progress there, but much more still needs to be done. And the third message, and remember that at the BIS we like to focus on risks, so I will highlight 3 risks for the global economy going forward. The first set of risks are of a more conjunctural nature. And by that I mean that there is a risk of seeing further episodes of serious financial distress in the years ahead across the world. Many of these are going to be very familiar, although the precise mechanisms could be a little bit different from those that we have seen in the past. And here is where financial innovation might come in. The second set of risks are structural. And that is the risk of entrenching instability and chronic weakness in the global economy. And it is here that the trend decline in real interest rates, the debt trap, and the hypothesis of secular stagnation come into the picture. And the final risk, which I think is further ahead, is more fuzzy, but should not be underestimated, is the risk of a rupture in the current open global economic order, with countries being tempted to retreat into financial and trade protectionism. So the structure of my remarks will say a few words about what is the financial cycle, what role it has played in the great financial crisis. And this, of course, is not just of historical value, because it highlights some of the challenges that many countries are facing nowadays. Then I'll say a few words about how it might be possible to adjust policy frameworks to deal with the financial cycle, and then elaborate a little bit on the 3 risks that I've just mentioned. So by financial cycle, I mean the self-reinforcing interaction between risk perceptions and attitudes towards risk appetite on the one hand, and financing constraints on the other, that can lead to serious financial distress and serious macroeconomic dislocations. Now, these self-reinforcing, what economists call pro-cyclical processes, are quite common, and they operate across a number of asset classes. You can think of equities, you can think of bonds, and so on and so forth. But, and this is a key point, those that have historically mattered most for serious banking problems have had 2 features. The first is that they're best described by joint booms and busts in both credit and property prices. And the second, which I think is even more important, is that these type of fluctuations, these booms and busts, tend to be much longer than the traditional business cycle. And by traditional business cycle, I mean how we as economists, how analysts, how policymakers think of the business cycle. Now, that business cycle is generally thought of having a length or a duration of up to 8 years, whereas the financial cycles that are really so disruptive have a much longer duration. They tend to have, since the early 80s, they had a duration of roughly 16 to 20 years. Now, in fact, the great financial crisis was no exception to this pattern. It was preceded by a very strong, by an outsized financial boom, just as many such crises had been preceded before. Think of those in Asia, in Japan, in the Nordic countries, and of course, if you go further back in history, even the United States in the 1920s and early 30s, the Great Depression in the United States. So in this sense, apart from the size, and here we go back to the specific types of financial innovations that took place ahead of the great financial crisis, think, for example, of various forms of mortgage securitization, there is really nothing special about the great financial crisis. It was simply retracing a pattern that we have seen in history many, many times before. Now, these regularities in terms of the financial cycle explain why such booms can be used to derive real-time indicators of future banking problems, horizons of between 2 and 4 years ahead. You cannot really tell when a crisis or how serious the crisis is going to be. But I mean, these indicators give you a rough idea of whether risks are building up in the system. And again, they're largely based on the behavior of credit, strong credit and property price booms. And also real-time measures of potential output by including information from credit and property prices, because we should remember that ahead of the great financial crisis, output was overestimated by a wide margin. Potential output was overestimated by a wide margin, and that was because people tended to focus on inflation, when in fact the signs of unsustainability in the economy were not taking the form of inflation as they had during much of the post-war period, but they were taking the form of unusually strong increases in credit and property prices. Now, it's very important to note that the financial cycle, its duration and its amplitude, they're not really historical, if you like, cosmological constants. They depend crucially on the policy regimes in place. And they have become bigger as a result of financial liberalization, which has basically weakened financing constraints, as a result of monetary policy regimes that focus very much on near-term inflation. They have forgotten so much about credit aggregates and monetary aggregates. And so that unless inflation is building up strongly, they have not really leaned against the buildup of these financial imbalances because there was no reason to tighten policy. And paradoxically here, they have also been amplified by the globalization of the real side of the economy, all of these things are very good, but if put together, if you think of the globalization of the economy, that provides fertile ground for the belief that you're going to have much stronger growth, while at the same time putting downward pressure on inflation, which therefore allows the authorities to permit this buildup of problems in their economies. And this is why, if you look at the duration and the length of financial cycles and their amplitude, they were much shorter up to the early 1980s, and they have become much bigger since. Now, the great financial crisis, like all financial busts, coincided with a balance sheet recession. Now, relative to a normal recession, balance sheet recessions involve much bigger debt and capital stock overhangs. They're much deeper, they last longer, their recoveries are weaker, they result in permanent losses in output, and they lead to much less room for policy maneuver because fiscal deficits balloon, because monetary policy interest rates immediately hit the zero lower bound, and as the governor was saying, the authorities enter a lot of unconventional monetary policies, increasing the size of the balance sheets. And because, of course, prudential buffers, be these capital or liquidity, vanish. That's basically what a financial crisis is all about. The other critical point is that these balance sheet recessions are far less responsive than normal recessions to aggregate demand management policies, because undercapitalized institutions restrict and, more importantly, misallocate credit, and because over-indebted borrowers simply try to pay that debt back. They realize they borrowed too much against unrealistic growth expectations, and now they pay back, so that whether you lower interest rates, whether you give them additional income, all they will do is simply save more. And in addition, boosting aggregate demand does not help with the major resource misallocations in the form of capital and labor that are disguised by the financial boom. Think, for example, in the case of the United States, of the growth of the construction sector, which is still paying the price for in this recovery. So hence the importance of balance sheet repair during these recessions. And again, as the Deputy Prime Minister and as the Governor mentioned, structural policies. Structural policies are absolutely critical in order to be able to return to sustainable growth. And it's a question, there is a serious question as to whether advanced economies have done enough in this context. So, what about policy? If you need to deal with the financial cycle, what should you do? Well, dealing with it, first of all, requires you to put it on the radar screen. And I'm not entirely sure how far policymakers have done so across the world. Second, you need a medium-term focus, because as I mentioned earlier, the financial cycle lasts much longer than the business cycle. You need policies that are more symmetric across the financial boom and the bust phases, policies that lean deliberately and persistently against the financial booms, but ease less aggressively and less persistently during financial busts, and policies that are holistic, I think it would be unrealistic to expect that you can deal with the financial cycle only by relying on prudential policies. Now, the key elements of the frameworks are well known. For prudential policy, it means putting in place macroprudential frameworks, and you have done quite a lot here in Turkey. Frameworks that have a strong systemic orientation and that put the financial cycle front and center of their measures. It calls for monetary policy which is able to lean against the buildup of financial imbalances even if inflation is stable and low. This requires a lengthening of the policy horizons, and it also requires acceptance of a higher exchange rate flexibility, because you may need to take an appreciation of the currency in order to do that, because financial booms tend to go hand in hand with capital flows and an appreciation of the currency. And for fiscal policy, and this is very important, it implies a much more prudent stance, recognizing the fully and the hugely flattering effect that these financial booms have on the fiscal accounts. The accounts look much stronger than they really are. And I think going back to something that was suggested by the governor, a tax policy that somehow it doesn't favor debt at the expense of equity. I think that there is a lot that can be done in that area. So let me finish with just mentioning a few things about the risks that I mentioned earlier. And I said that there are three risks. The first set of risks are conjunctural, and that is the risk of further episodes of financial distress, financial crisis in the years ahead. Now, in the annual report of the BIS, we identified a number of countries where seemingly unsustainable financial booms have been building up following the financial crisis. And these are identified using the types of indicators, the types of measures that I was measurement that I was discussing at the beginning of my presentation. They served us well ahead of the great financial crisis. They may serve us well again ahead of the possible future crisis. Now, the set of relevant countries includes large emerging market economies, including some very large ones, but also some advanced economies that were less affected by the crisis, because in those economies you had big financial booms even post-crisis. Where advanced economies that had faced the crisis were retrenching, these economies were actually facing expansion. Now, importantly, the monetary policy in these countries has been significantly influenced by the monetary policy in the core economies. I'm thinking in particular of the United States, but also the euro area and to a lesser extent Japan. Because for fear of exchange rate appreciation, these countries have found it very difficult to operate with interest rates that are significantly higher than those in the major advanced economies. And as a result, the authorities have relied almost exclusively on macroprudential tools to deal with this problem. So the question to ask is whether, the question that we should all ask, is whether these macroprudential tools are going to be enough. Now, this raises broader questions about the international monetary and financial system, but I don't have, and the spillover effects, but I don't have time to go into them. So the second set of risks is structural. And as I said, that's the risk of entrenching instability and weakness in the global economy. The risk here is that of asymmetric policies across successive business and financial cycles, policies that don't lean against the build-up, but ease aggressively against the bust, lead to a sequence of financial crises in different parts of the world and a loss of policy ammunition. So in particular, if you're thinking of interest rates, this sequence imparts a downward bias to real interest rates and an upward bias to both private and public debt levels, which at some point makes it very hard for policymakers to raise interest rates without damaging the economy and to address the risk of another crisis, because, as I said, they run out of policy ammunition. This is akin of a debt trap. Now, macroeconomists call this time inconsistency, but this is an awkward term for a very simple concept, the idea that actions that may seem quite reasonable and compelling when taken in isolation, taken as a sequence, lead policy astray. Now, I think there are signs that this is happening. As the annual report highlights, debt levels in the global economy have been growing. We have a number of countries with unsustainable, and very large countries, with unsustainable fiscal positions. And as we have seen, it has become very, very difficult to normalize monetary policy, both interest rate policy, but also unconventional monetary policies. So on this interpretation, the trend decline in real interest rates that we have seen since the 80s, but in particular since the 1990s, has not so much mirrored deeper forces such as savings and investment imbalances, but over a sufficiently long horizon, they have been part and parcel of those forces. In other words, low interest rates have tended to produce outsized financial booms that then collapse. They generate very long-lasting effects on real output. These imply further reduction in interest rates, balance sheet or unconventional policies on the part of the central banks, so that as a result, these very low interest rates become self-validating. And the final risk, as I said, is institutional, and that is that the risk that at some point we will see a rupture in the opal global economic order that we have come to admire so much. And that is, I think it's important to realize that the open trade and financial order has proved remarkably resilient to the great financial crisis. But I think it's worth asking whether it would prove equally resilient where other crises emerge in the future. I think that at some point the temptation for nation states to withdraw should not be underestimated, and the temptation at that point then to inflate debts away through a mix of inflation, financial repression and autarky could actually prove irresistible. So the bottom line is that taming the financial cycle is important. I think the stakes are high. As discussed in the annual report, progress has been made, but considerably more needs to be done. I think the road ahead is a long one. All the more reason, therefore, to start sooner rather than later. Thank you very much.
Claudia, thank you for this concise, sharp, and excellent contribution to the topic. Now I turn to our second panelist, Bojan Markovic, former Deputy Governor at the Central Bank of Serbia, and currently he is one of us here in Istanbul. He's the lead regional economist at the EBRD, and previously he held a position at prestigious places such as Bank of England and Goldman Sachs, and I think that should be sufficient to describe him, and it's now your floor, Bojan.
Thank you very much, Turalay. It's a pleasure to be here. It's a pleasure to live in Istanbul. After Claudio's all-encompassing view and very good view, I would like actually to pick and choose some particular details in the area of financial innovation which might be more concerned of Turkey and also some other regional countries, and which draw from my experience as a deputy governor, but also from my experience in these several months that I'm lead economist for Turkey, among other countries in the EBRD. And I would like to start of some positive impact of financial innovation. When I was a deputy governor in Serbia, I was the one to push for deepening and developing derivatives markets. We had quite a lot of corporates. It was a small open economy, quite a lot of exporters, importers, quite a lot of corporates who were exposed to the exchange rate risk, one or another way. And we didn't have the basic derivatives market, the basic FX hedging market. So derivatives can indeed be very positive. Another positive thing with derivatives is that, or financial innovation in general, is that financial innovation may actually be necessary to push with technical innovation. And indeed, technical innovation, I believe, is a very pertinent thing in Turkey. The governor indeed has mentioned the plans to develop and prosper the venture capital with the development of Istanbul as a financial hub. But innovation in general is a topic of the forthcoming transition report of the EBRD coming in November. And because it's of such an importance of Turkey, Turkey will be one of the first countries where we will present our transition report when it comes in November. Now, if we are thinking about innovation at the firm level, those were usually projects with uncertain outcome, projects with volatile cash flows, projects often done by small or young firms or startups. In our countries of operation, EBRD's countries of operation, most of the finance comes from the banking sector, but banks do not often have enough expertise or will to lend to such projects. So in order to finance such projects, some financial innovation is often needed. Be it development of the venture capital, be it factoring, selling the account receivables to specialized lenders, being online lending peer-to-peer, or indeed credit scoring. But effectively, I would really like to make a point, that financial innovation can really help develop technical innovation and long-term growth. However, despite these positive things, there are of course some challenges that come with financial innovation, challenges that concern financial stability and monetary policy. One of the issues, and I will here build on Claudio, is a spillover effect or larger international finance which comes due to existence of electronic trading, possibility that someone sitting in California can invest easily in Turkish bonds. That is a recent phenomenon. It's particularly important in this time of ample global financial liquidity. But although that's a very positive development, because it leads to optimal allocation of finance, stimulates growth, it also brings some challenges to the monetary policy and financial stability. International finance is usually more volatile than domestic finance. Foreign investors or foreign investments, portfolio investments, usually at the beginning tend to be very short run. In time, with the development of the financial markets and deepening, it tends to go more towards the longer end of the yield curve, but at the beginning, it's usually short run. As foreign investors have less knowledge about the particular economy than domestic investors, it also tends to be subject to sudden reversals or sort of more volatility. Also, financial innovation allowed foreign investors to split the risk that they are taking into the country between the interest rate risk and FX risk. When I was in Serbia, it was a very young market. We saw quite a lot of foreign investors coming, investing in Serbian bonds, but not being willing to take a position on Serbian currency. So through various financial derivatives, they were actually trying to eliminate the FX risk. Now, what this means for monetary policy in a country? Well, first, what we saw in Serbia, it meant that we had some issues in how to monitor the developments. So the monitoring usually went through domestic banks, but when the derivative market develops, and especially when the offshore market develops, the monitoring for the monetary policy of the central bank becomes very tricky. The second challenge that we had as a monetary policy in the central bank is that our models did not work as well. We had to adjust models very frequently, and in inflation targeting central banks, we tend to rely on models to inform our decision. And the final thing is that some of the standard tools that we kept using, such as reserve requirements, became less effective because reserve requirements were done on were subjecting the bank's balance sheets and not only off balance sheet positions especially not the offshore trading. Of course, there were consequences on financial stability as well, because the system was more vulnerable to sudden shifts as the number of short-run foreign investors grew. Also, some of the financial innovations brought up not only benefits, but also some of the complicated, structured products with or less transparent products, and therefore, led to our not very well informed market participants, the market participants with low level of financial education, to take some excessive or undue risks. Now, the risk for financial system comes even if banks do not take that risk, but their clients take that risk. In particular, in Serbia, clients were taking the FX risk, so the exposure of clients to FX risk led to the large share of non-performing loans once the crisis started and currency started to move. So all of that means that financial innovation, while being a very positive development, can also bring big challenges to the financial stability and the monetary policy. So the question is, what should one do? Well, the first and foremost is we shouldn't close this market. These markets really bring benefits. We shouldn't really went to lengths to limit the development of derivative market or other financial innovations. The second thing, we should really actively steer towards sustainable structures before the crisis starts, as the governor mentioned before. And that steering may be through having active strategies of how to develop some financial innovation instruments and how to steer away from others. Let me give you an example from Serbia, bearing in mind that Serbia was much less developed financial market than what is Turkey here. But in Serbia, we didn't even have a basic swaps and forwards, yet, like some of the market participants wanted to engage into the non-deliverable forwards, some more complicated structure. So having a strategy at the level of major agents, and that's like the central bank and the capital market board and the Ministry of Finance in Serbia, to develop the basic, more plain vanilla derivatives and to steer away from complicated structure was a very important part of keeping up the sustainability. Also, one should have a strategy how to attract the long-term strategic investors in the market. So once we open up the market, especially due to the ample financial, liquidity in the global financial markets, it's normal that at first we'll have more of the riskier, more short-run investors. But essentially speaking, with longer-term investors will help actually bring the right balance amongst our investors base. Related to that, and especially relevant to Turkey, is we should try to develop domestic investors base, especially for the long run. And that has quite a lot of challenges. The pension funds, insurance industries is still underdeveloped in all our countries. Those are natural long-run investors. So to bring the right balance and reduce the volatility and vulnerability of the markets associated with either financial innovation of various sorts, is we have to develop those who will bring in the right balance. For that, we need strategies. The other important thing to keep the vulnerability at bay is to educate and protect. Increasing the financial literacy should be done by regulators as well. And it should be done at all levels, at the levels of consumers, at the levels of corporates who may be taking undue risks when the financial innovation or derivatives market develop. It should be also done at the level of banks who can also re-educate their clients. Consumer protection measures are also very important because one of the major problems with financial innovation is a non-transparency. So if the product is rather complicated, it's quite possible that those who are buying into that product are not aware of the risks they are taking from those products. With a complicated product, and I will here mention the collateral as debt obligation, collateral as loan obligation, all of these things that actually steer at the start of the crisis 2007, 2008, we had a situation whereby banks were, or sort of other agents were bundling up the products and selling them without taking the risk on that product, but those who were buying them didn't really know what kind of a risks they're buying. So when risk was hidden, it was first not adequately priced, and the second thing, we didn't know really where the risk was based. So as regulators, we didn't know which areas to focus in order to prevent the financial crisis steering away. So consumer protection measures and increasing transparency through consumer protection measures. Say, for example, in Serbia, what we've done is we required banks to dispose the exact FX risk schedule to any consumers who would be taking the FX loans. But there is a set of these type of measures that can be done in order to reduce the non-transparency of some of the financial innovations coming into the market. The next thing is regulate. We shouldn't over-regulate, but it shouldn't be hesitant to regulate. And in particular, I'm not here speaking necessarily about Turkey, but I'm speaking with some other countries. They shouldn't rush of going out of some capital control measures. In particular, in Serbia, we had a measure of corporates. We've seen that corporates starting taking undue risks once the swap market starts to develop. So we had this requirement of having underlying documentation for corporates to enter the swap or forward arrangements. So it's a capital control measure de facto, but it's a capital control measures which can be justified in areas where financial literacy of market participants is not still at the level that they know what kind of risks they are taking with buying into certain financial innovative instrument. Also the regulations regarding open positions of banks and a set of other regulations regarding the setting the proper macroprudential framework that Claudio has elaborated about that quite a lot. Another important thing is to ensure the proper monitoring. And in this sort of very dynamic environment, the central bank has especially big task, given that it's tasked with the financial stability, to keep changing the monitoring framework in order to respond and be able to efficiently monitor developments in the changing environment. We should do that, however, without overburdening the banks. So we should have a good measure of what we require from market participants, but we should be sure that the things that we require are sufficient to actually give us the picture of what's happening in case of some volatility appearing in the financial markets. And developing especially a good market intelligence function proved very important to get a timely information about what's driving the market developments at that particular moment, and to get the information of what's happening in the offshore markets in that particular moment. So the markets, offshore markets are particularly important because central bank cannot really require offshore market participants to regularly deliver information, but through market intelligence channels we can do quite a lot. And finally, apart from having a good macroprudential framework, it is important to have a good set of contingency measures, the arsenal of contingency measures, which is ready to smooth the capital volatility or the capital outflows if and when the big shocks happen. And there, we shouldn't hesitate to use the standard measure, like the interest rate. Indeed, like the Turkish Central Bank move in January 2009, which was very effective in stabilizing the volatility of the market at time, proves how effective interest rate can be as a measure to stabilize the market. But of course, we can use other measures, such as the standard FX intervention, or the intervention, de facto intervention through the reserve option the Turkish Central Bank has, or through the varying FX requirement that reserve requirement that other central banks can do. That particular measure is a very blunt instrument. It shouldn't be used too often, but it can help in case of big capital outflows. And also one thing which we saw as a very important in Serbia is being able to quickly change the credit facility rate in case that there are some big movements in the non-deliverable forward offshore markets. So to conclude, I would like to send a message that financial innovation is very important. It has big positive effects, and we should by no means try to limit the development of financial innovations, but it should try to actively steer towards developing those financial innovations which are adequate for the level of financial literacy in our particular countries and for the needs of a particular economies in terms of the development. And as central banks, as monetary policy makers, as guardians of financial stability, we should also flexibly adjust our systems to be able to efficiently monitor and to efficiently react to efficiently monitor the developments and to efficiently react on any undue developments to preserve the financial stability in the country. Thank you.
Well, thank you very much for your expert view with a great deal of regional perspective. Now I turn to our last panelist, Guyula Pleshinger, member of the Monetary Policy Committee at the Central Bank of Hungary. It's fair to say that your central bank, one of the central banks, have been very busy with developing innovative monetary policies. So we are very eager to hear from your experience in monetary policy innovation. And very briefly, he has many experiences at different fronts in the private sector, in the official sector, and he was the former Minister of State for Taxation and Regulation. Floor is yours.
Thank you, and thank you for the compliments. Good morning, ladies and gentlemen. Thank you very much for having me here on this distinguished panel. Most of the speakers of yesterday emphasized the importance of the financial innovations, listed all the pros, so they just pushed the accelerator. So now I'm here to join my colleagues to drive your attention a little bit to the brakes, not by questioning the importance of the financial innovations, because I am for the innovations myself, and in brackets, as a once investment banker, I wouldn't like to die before a Hungarian entity chooses the first to cook. But what I try to do is I try to draw your attention to the risks that might be associated with different innovations. So let me first run through the innovations that took place in the course of the last decades. First of all, obviously, the product innovations. So we had, you know, the swaps, the options, the swaptions, the securitizations, the credit derivatives, the derivatives on derivatives, and derivatives on derivatives on derivatives. So finally, even the underlying asset was difficult to digest. So the improper knowledge or understanding of these products could lead to a risky situation. Next to that, there were some organizational innovations. So once upon a time, the risk management was also the responsibility of the front office. Step by step, it was separated, and the risk management was moved to the mid or the back office with much less direct relations to the clients. And from that point, the front office became responsible only for generating deal flow. And this also could be a source of risk. And last but not least, the technological innovation was already mentioned. This automated and high-frequency tradings could be considered. Yesterday, Mr. Meyer-Fucher talked about these instruments, and he visioned also trades executed in nanoseconds. So if you take into consideration that roughly 50% of the equity trade volumes in the US is executed on these platforms, then we can understand that this method could really cause liquidity and volatility risks. Just remind ourselves to the early days of May in 2010, when due to the high-frequency traders' actions, the Dow lost some 10% of its value in a couple of seconds. So it could be really a source of risk. So to sum up, no question about that financial innovations have a positive effect, so they can help to optimize the distribution of the resources. This way they could be added value to the potential growth, and in some cases, or up to a certain limit, they could be used as risk management assets. Again, let me refer to Mr. Meyer-Fucher, who told that they at NASDAQ have some systems that could monitor and evaluate the risks. But in adverse market conditions, and this is our takeaway from the crisis, the risks associated with the single innovations could pile up and could lead us to serious systemic risks. And certainly the spillover effect of the shocks became much stronger and much faster. And last but not least, as a central banker, I have to mention that these innovations could influence even the traditional transmission channels. For example, if there is a shift from the traditional bank lending towards the other form of financing, it could be equity or direct financing or bond financing, then certainly the efficiency of the lending transmission channel would be less efficient. Or if the interest rate or yield expectation are based on the FRAs, then obviously this expectation channel suffers. So what's the main challenge now for the regulators and the central banks? As His Excellency the Deputy Prime Minister correctly pointed out, the proper understanding and interpretation of the risk is crucial. Now we are witnessing a shift from the spot markets to the derivatives market. It has some positive effects. On one hand, just taking a Hungarian example, they can stabilize the spot market. So when they announced the tapering, or when the tapering was announced, then it was not at all sell-off on the Hungarian bond market, but the volume of the IRS market increased substantially at the same time. And also these derivatives gives us much more data regarding the expectations on the exchange rates, on the interest rate. So our job is to correctly understand and interpret these data and to put them into a global context instead of looking at from just a local point of view. I have two figures demonstrating how the emerging markets are integrated into the international markets and what are the effects of the innovations. The left-hand side graph shows the level of integration, so it shows that the emerging markets reacted to the crisis on the same way like the developed markets. Certainly in percentage times, the reaction on the emerging markets was much more aggressive than the developed markets. The other chart shows the volatility, which was caused partly by the innovative products introduced after the Lehman crisis. Certainly, the volatility or the increase in the volatility cannot be attributed just to the innovations. A lot of other factors, the central bank interventions or the regulators' interventions also influence the volatility, but the innovations had a significant role in them. So now arrived to conclusion. So how should we compete with the risks? On the long term, certainly, as it was mentioned, a stable fiscal and external balance should be kept, but this is for the fiscal policy. The regulation could help in some cases. For example, the ECB's ban on the naked CDSs helped something, but again, in brackets, it caused the liquidity leaving from the CDS market, and as a consequence, the CDS spread of the emerging market countries dropped by 50% on average. In Hungary, it dropped by 100 points. Now it went back to the average. So now the difference between the emerging market spreads and developed market spreads has to be reevaluated. But anyway, by and large, this really helped. The capital controls also could help. The capital controls could aim at making the more difficult structures or the more complex structures more expensive. And it is important to understand that these measures, these control measures, could work on a temporary basis. Why? Because the high-flyer investment bankers come up with newer and newer innovations, and they can circumvent the different controlling measures. So these capital controls have to be revised from time to time, have to be fine-tuned, and have to be changed whenever it's necessary. As Bojan has already mentioned, a stable investor basis, as possible, as much consisting of domestic investors could definitely help. So to attract long-term stable investors could be again a challenge for the regulators, the countries, and decision makers. And if you don't mind, I just give you an example of Hungary. So Hungary is or has been a victim of some financial innovations. Roughly 10 years ago, the interest rates on the Hungarian foreign mortgages was as high as 20–25%, so it was extremely high. So at that time, some foreign banks, mainly Austrian banks, started to offer foreign exchange denominated loans at very low interest rates. At those times, you may remember that there was a huge liquidity boom on the markets, on the international markets. So they offered these foreign exchange mortgages mainly in Swisses and in smaller part in euros. And when the crisis came, the liquidity disappeared, and the debt service obligation of the borrowers doubled or even tripled. The reason for that was that the banks offered long-term FX loans, but in fact they financed themselves for short-term swaps. And when the liquidity disappeared, then this whole system blew up. Certainly, I don't really want to put the blame on the bank, because at that time this structure didn't seem that risky, because the interest rate difference was quite substantial. At those times, the foreign exchange rates were quite stable. The Hungarian forint Swiss franc or the Hungarian forint euro was quite stable. And at those times, Hungary was supposed to join the Eurozone in the then foreseeable future. But anyway, so by now the situation became quite difficult, and the government started to make administrative steps to improve the situation. I would be more than happy to give some more details if you are interested. And finally, let me just summarize the innovations that Hungary implemented as a reaction to the crisis. So first, we integrated the previous watchdog with the central bank. So now we have a single unit, the central bank, that is responsible for the macro and the microprudential supervision. We tried to prohibit the foreign exchange lending at all, but we failed because the EU considered it harming of the level playing field. So we just made it quite difficult. We implemented several macroprudential rules, capital controls, to preserve the financial stability. We started a so-called funding for growth program. It is slightly similar to the UK's funding for lending program, and this aims at helping the SMEs to get cheap financing. And just recently we started a so-called self-financing program that is aiming to increase the domestic share or the domestic share in the debt financing of the country. So thank you for your attention, and I would be more than happy to respond to your questions, if any. Thanks.
Thank you very much. Unfortunately, I have been instructed not to take any question, so I'm going to summarize what we learned from this. What I can say is that we got to be very aggressive about financial stability, and we got to be very careful about unconventional monetary policy. I don't know whether it is fair summary of the discussion or not. Well, thank you very much for your excellent contribution. That was very clear and excellent presentation. Thank you. Thank you very much.